Good morning, everyone. You are watching live a daily market outlook for Thursday, 5th of April 2012, prepared by Windsor Brokers. The markets are mainly healing their wounds of the sharp losses or gains now, depending on the currencies. In the past couple of days, especially the euro and sterling are currently in a slight recovery mode, while dollar is slightly correcting against the yen and the Swiss franc, but still holding not far from the recent highs or lows, depending again on the pairs. The overall outlook, especially that risk aversion is now regaining speed, remains quite negative for a single currency, and the sterling, as also in light of recent economic indicators released, actually the ones from yesterday, showing that the eurozone is still struggling and still is in the deep crisis. The business floundered in March, and the growth cooled in the service sector, also in the United States, took some steam out of the global economy recovery. The data of yesterday's from US ADP data showing that US employers added more than 200 jobs last month. That keeps at least the labor market still in the positive track, and tomorrow's non-farm payrolls are expected to confirm this. However, from the other side, the Eurozone business data further turned the outlook grim in the region, showing that the Eurobloc is in recession. As the composite purchasing managers index released yesterday adds a gauge of activity in firms ranging from factories to restaurants, again edged down, hitting 49.1 in March and slipping further below the 50 mark. That is the level dividing growth from the contraction. The reading has now fallen in 6 of the last 7 months, and survey complier markets said the report probably consigned the Eurozone to recession, defined as 2 consecutive quarters of contraction in gross domestic products. At the same time, the markets group zone services PMI edged higher to 49.2 and was a little less gloomy than a preliminary reading had showed. Also, firms sounded more upbeat about the future, with businesses' expectations at an 8-month high. Rather mixed data, but still a strong fear of further recession for the Eurozone especially remains. This is also in light of recent releases of interest rates from European Central Bank yesterday. In the minutes of FOMC that we commented yesterday, also that no signs of further quantitative easing is seen for now from Federal Reserves. However, the comments of Eurozone President Mario Draghi yesterday, after holding the rates unchanged, showing that the Eurozone is still more towards the recession, and the risk remains at that side. As he commented that there is still too early of exiting strategy to be imposed at this point. Also today we have the Bank of England rate decision due at 11 o'clock GMT, and most likely the Bank of England is set to leave its policy settings on hold on today's meeting, as growing evidence of a modest economic recovery reduces the need for extra monetary stimulus. So basically, the Bank of England will be likely following the steps of their American and European colleagues. The central bank will announce its policy today, as I said, at 11 o'clock GMT, and the polls shows expectations to Bank of England to leave interest rates at the target for its asset purchases unchanged after it decided in February to buy 50 billion pounds more of gilts. Most of economists also took the view that Bank of England will not expand its quantitative easing program this year. Recent signs that the economy will avoid a recession, coupled with the worries about potentially sticky inflation support that view. Surveys of purchasing managers released this week show the surprise pickup in growth across British services, manufacturing and construction in March. If these strong results can be sustained into April, then it will be likely the final nail in the coffin for another round of quantitative easing, according to the analysts of the markets. Moreover, a recent rise in oil prices has raised fears that British inflation will not fall towards the Bank of England's 2% target as fast as policymakers hope. The British consortium of retail said yesterday that food prices rose in March at the sharpest annual rate since June, driven by higher transport cost stemming from a more expensive oil. From today's calendar, as mentioned already, we have the interest rates from UK due at 11 o'clock GMT, and now already released is the Swiss CPI that we're going to just take a look, came out at 0.6% on the monthly basis versus the forecast of 0.4% for March reading. Next to come is UK's industrial production at 8:30 GMT. March reading expectations at 0.4% compared to minus 0.4% of the previous month. So this is what we just discussed, what we mentioned earlier. Improvement in the UK's economy is going to completely sideline the further quantitative easing. Manufacturing production is expected to stay unchanged today at 0.1%. From Germany, 10 o'clock GMT industrial production for February decrease, and the negative forecast for today minus 0.3% is seen versus the quite positive previous month. January's release at 1.6% growth in the industrial production. As mentioned, the Bank of England rate decision is due at 11 o'clock, 0.5% unchanged the policy. Today's US Challenger job cuts are due at 11:30. We have no forecast. 51.7 thousand is the previous month release. From US also the unemployment claims weekly release, 355,000 is forecast for today for new claims for jobless, lower than the previous month, revised to previous week, revised to 359,000. From Canada, unemployment rate expected to go higher, 7.5% forecast for today compared to 7.4% of the previous month, while employment change is showing increase by 11.3 thousand compared to minus 2.8 thousand of the previous month. IVPMI from Canada due at 1400 GMT shows a decrease to 65.2 from 66.5 of the previous month, and that was all from today's calendar. Ahead of tomorrow, which is a quite busy day despite the market holiday of Good Friday tomorrow and some early closure of the markets. The full calendar for tomorrow, including the US non-farm payrolls as the first Friday of the month, will likely keep the markets at high speed, at least during the European and early afternoon hours, and will be closely watching the developments in the market. From the technical outlook, we're going to see now what are the recent movements in the majors and the commodities. The euro basically is in a mild corrective action of yesterday's fresh low at 131.06. where the bottom was found just ahead of 131, our next target, and around figure support. However, the current recovery was quite mild, as 131 50 60 zone capped the upside for now, along with the 20 days exponential moving average as shown on the hourly chart, with the hourly studies still in the negative territory and already started now pointing lower, seeing more potential for further extension of the latest weakness of 133.80 zone that capped the previous upside action of 130.00 base of 15th of March 2012, with market extending losses more than 61.8% retracement of the whole up leg from 130 to 133.84, keeping the downside firmly in focus. Studies on 4-hour chart are also negative, back to the oversold territory, with the loss of 131.06, 131.00 to open next, minor support at 130.50, which is also the base of Ichimoku cloud on the daily chart. That will open way for further weakness. The Ichimoku studies are now turning negative, but still no firm signals of any further action. We need to see the minimum break of the cloud lower in order to confirm the negative stance based on Ichimoku studies, and the loss of 130.50 to open our next significant supports at 130.00 low of 15th of March and 129.73 low of 16th of February 2012, strong support and double bottom, loss of which would turn more negative the larger picture of euro dollar, as it will more harm the recovery attempt of 126.22 yearly low posted on 13th of January that peaked at 134.85 end of February. Studies on the daily chart are also losing traction, as loss of near-term bullish momentum of 130.00 that peaked at 133.84 and subsequent weakness broke below the momentum's midline, with MACD also now approaching the center line and the RSI pointing lower and holding below 7 days moving average, seeing potential for a further easing of the pair's price. Just briefly back to the near-term outlook. On the upside, initial barrier is around the 132 and the 132.20, whereas the 20 days moving average on 4-hour chart, and basically only break above this level would ease the immediate bear pressure and allow for some stronger recovery, but prospect for a stronger correction remains quite limited, as the next strong barrier at 132.50 comes and likely to cap the upside in case of any break higher at this point, as the moving averages are firmly pointing lower and the 20 days one crossed below 55 days one at 132.80, signaling further pressure on the pair's price. Sterling is also in the brief corrective action of yesterday's fresh low at 158.32, as the price descended sharply from a recent yearly high at 160.61 posted on 2nd of April, accelerating losses on break below 159.80, 159.65 initial support, clearing also 159.20, 159.00 and 158.60 that bottomed so far at 158.32. As we can see, the outlook on the 1 and 4-hour chart are still negative. There's some improvement actually seen on the hourly studies, as some momentum has been regained, but missing a firm break above initial dynamic barrier at 158.94, currently 20 days exponential moving average, with 55 days still holding above the price, currently at 159.17, keeping the pressure on the pair's price, as the recent corrective action did not manage to clear initial barrier at 159 zone. That was a brief break was seen to 159.07, and that was all seen during the Asian session, with the current congestion under the 159 zone, within still negative outlook, as the pair again attempts below 20 days exponential moving average to open way for further easing and mark the end of the corrective action. Only firm break above 159.20 would allow for some stronger corrective action. However, negative structure on 4-hour charts where the moving averages are currently at 159.20-25 levels. Also, this is the 38.2% Fibonacci retracement of the latest down move from 160.61 to 158.32, offering quite a strong barrier at this point, and seeing no much potential for the stronger correction at this point. A break below 158.32 to open next group of supports. 158.00 is the next one, round figure support and low of 26th of March, and close to it 157.69, 22nd of March 2012 low. That will be the downside targets. Only firm break above 159.20 would delay immediate bearish action and allow for some stronger recovery, but not to expect some more significant movements as long as 159.70-80 resistance, where is also 61.8% retracement, stays intact. Only break above this level would return back to the positive tone and refocus levels above 160.00. The dollar yen's recent recovery attempt off fresh low at 81.54 posted 2 days ago failed at 83.00. That is our initial resistance, previous consolidation range floor that is capping the upside for now. There were two brief breaks on the larger time frame to 83.38 and 83.29 where the gains were stuck, were limited, and the overall tone remains skewed towards the downside, more towards the downside, as on the hourly chart the studies are still in the negative territory, with the latest rally from 82.00 zone that now offers good support being capped at 82.67. On the downside, this is immediate support at 82.00, break of which is turn more negative the near-term structure, and possibly refocus 82.54 for a test and break below this level to open way for further retracement of the broader up move from 76 that peaked at 84.17 in the recent days. Back to the lower time frames, the current action is within the narrow range between 82 and 83 with strong support at 82.00, and studies still turned towards the downside as hourlies and 4-hour are still holding below the midlines, and the recent break of loss of momentum on the 4-hour chart keeps the downside more vulnerable for possible test of 82.00 and then 81.54. On the daily one, the break below our initial strong support at 81.54 is expected to open next Fibonacci level at 81.05, which marks 38.2% retracement of 76 to 84.17 rally. From dollar Swiss, the pair is in the recovery mode of 90.00 base, with the hourly studies now attempting to pick up again after support was found at 91.40 zone overnight, and pullback of 91.81 peak seen yesterday. The retracement of over 50% of the latest down move from 93.33 down to 90.00 keeps the positive tone and focus at the upside, as the initial resistance at 91.75 zone, the tops of 22nd and 19th of March, along with 50% retracement, has already been dented. That keeps prospect for further extension higher, with this morning's price action and the bounce towards this level being more supportive for this action. On break above, firm break above 91.80 previous high to open next significant barrier at 92.00, as round figure resistance and the 61.8% Fibonacci retracement of 93.33 to 90.00. On the downside, immediate support is overnight low at 91.41, ahead of more significant high at 91.00 round figure support, and the 20 days exponential moving average, and the high of 29th of March, pardon, at 90.70 zone, where is also 55 days moving average. Holding above these levels will keep the near-term structure fully in play in case of any further easing. For now, the outlook remains more turned to the upside, but we need to see the break above 91.75, 91.80 in order to confirm. Only loss of 90.70 zone would signal an end of the current corrective action and open way for possible retest of 90.00. On the daily chart, the studies are pointing higher now, attempting to break above their midlines. That will turn the structure more positive following the latest slide of 93.33 that bottomed at 90.00, just ahead of our downside target and strong support 89.30 double bottom. Current recovery, as said, initial step break above 91.75.80, and then 92.00, 92.35, where is 90 days moving average on the daily chart, ahead of 92.56, the main bear trend line drawn of 93.33, to further improve the structure on the daily chart and possibly refocus 93.33 peak of 15th of March 2012. On the downside, only loss of 90.00 base would further weaken the structure, but we have to notice that the pair is currently moving within the triangle, and the break of either side of a triangle would define the near-term direction. With the current configuration of studies on the lower and higher time frames, seeing more potential towards the upside, as the dollar remains strong after latest FOMC decision. FOMC minutes being released sparked a fresh strength of the dollar and a fresh risk aversion. A quick look at crude oil. Daily structure is weakening now according to the Ichimoku studies, as they are all pointing lower, and currently the near-term support was found yesterday at clouds base at 101 zone. 101.31 is currently the base. 101.07 seen so far, keeping the focus at the downside. A few signals from Ichimoku are pointing lower, and this keeps the downside in focus. On the hourly chart, the studies are still in the negative territory, however pointing higher, but recovery attempt of yesterday's low at 101.07 was so far quite mild and shallow. 102.32 was seen, where 20 days exponential moving average capped the upside. To improve the current structure, we need to see a break of minimum, regain of minimum 103 level, 103.20, where is the 4-hour chart, 20 days moving average. But at this point, studies are firmly negative and all pointing lower. That makes very small hopes of further recovery, as the overall near-term downtrend remains fully in play of recent peaks at recent ranges, ceiling at 108.68. Immediate threat is seen on test of psychological support at $100 per barrel, as the oil's price yesterday briefly broke below our next dynamic support that we mentioned in yesterday's presentation at 102 zone. That is 90 days moving average, opening way for further extension lower, as the previous range ceiling at 103.17 has been lost. Loss of $100 per barrel level, as a strong psychological support would likely open way for a further easing, with a significant static support seen at 95.50 zone, ahead of 200 days moving average at before this is 200 days moving average, pardon, at 95.72. On the upside, the daily structure would improve only in case of break above 105.45 high of 2nd of April 2012. The yellow metal remains also under heavy pressure after losing its initial supports, strong support at 1628, dipping down towards 1600, our next near-term target as psychological and around figure support. 1612 was seen so far ahead of latest mild recovery that is still being capped at 1627 zone, limited by 20 days exponential moving average. Hourly studies are emerged out already of the oversold territory, but the other ones are still holding below their midlines, and despite pointing higher, keep low prospect for some stronger and more significant corrective action. Next, static resistance at 1628, pardon, the previous low, and 1638 low of 3rd of March, 3rd of April 2012 offer quite good resistance at this point, and is expected to limit the upside as overall picture, including 4-hour charts where the studies are quite negative and still pointing lower despite being in the oversold zone, seeing potential of further easing. Loss of 1600, our next support, as the pair already broke below 1624, the 61.8 Fibonacci retracement of the broader down up move from 1522 to 1790 would put additional pressure, would break below 1600 level to open way for possible revisit of the key longer term support and double bottom at 1532, 1522 lows of 2011, 25th of September and 25th of December 2011. That was all for today. Wish you a nice day and good luck. Thank you.